So let me take this opportunity to welcome you all to our online class for advanced financial management. Today we are going to be doing the last part of the techniques of handling risk. And remember, these techniques are mostly tested in our exams. I have already done some of them. And the ones which I have not done, I will be able to do them today. So today I just want us to look on scenario analysis. And we know that we said a scenario analysis is just an improvement of sensitivity analysis. Since already the difference which is being, or the difference which normally appears between the two, it is based on the changes in the decision variables. We remember very well we say that when you are going to be working on the first topic of ours, we were going to be looking on the how can we be able to make these decisions based on the risk which are basically involved. We were able to discuss about the net present values and most and so on. These techniques that we have already discussed, they are going to be assisting us to make decisions in a certain way where we are going to be relying on a data which is basically provided. Now, in this case, we are saying that when we look on the sensitivity analysis, we are going to be arguing about the changes which are basically expected on other variables, not only they are the only dependent and dependent variables which we have already discussed there before. And remember these decisions that you're going to be making, basically they are slightly differing based on the results that you're going to be getting from the calculation of the NPV. You have seen that in every question that you're going to be doing under the techniques of handling risk, the first stage that we have to be doing is the computation of the NPV. And you remember that if you are able to listen to our previous videos, you'll be in a position to understand why we are supposed to be making decision in a certain way. So when we are discussing, because already today we are doing advanced financial management, let me just write here, advanced financial management. And we have said, and our advanced financial management, we just want to discuss the technique of handling risk, number 4, where we are discussing about scenario analysis. We are discussing about scenario analysis. And when I look on the scenario analysis, I will be able to say it is an improvement of sensitivity analysis.
Excuse me, sir.
It is an improvement.
Excuse me, sir.
Yes, yes.
You are to attempt a question on sensitivity analysis before we proceed to another subtopic, or you have changed your mind?
Very good. I have said at the beginning, maybe you did not listen to me. I said, before I do that question, let me first introduce scenario analysis, and then I will be able to do that question. That is what I am saying.
Thank you.
I will be able to do December 2022, but I have to introduce scenario analysis before I do the question. Now I have said that a scenario analysis is an improvement of sensitivity analysis. It is an improvement of sensitivity analysis, which is making more practical. It is improvement of sensitivity analysis. Sensitivity analysis, which makes it practical. Which makes it practical. We have said it's just an improvement of sensitivity analysis, which is making it more practical, since a change in a decision variable is expected to affect the other variable, right? Since a change in a decision variable, since a change in a decision variable will cause a change in other variables. So if we are going to be having a change, like today, we are having a lot of changes which are happening on the world of taxation. For the students who are supposed to be doing advanced taxation, you have to be looking on the the current trends, because they are going to be appearing mostly in your exams. So it means that a change in, for instance, we might be discussing about the reintroduction of a certain taxes which were already scrapped, is going to be causing a change on the other variables. Maybe we are discussing about the change in the price of the commodities among other changes. So in this case, those are the analysis that you're going to be making, and that is where we are saying that a scenario is just an improvement of sensitivity analysis, because it basically makes the analysis more practical. Because a change in a one decision variable is going to be causing a change in other variables. So if, for instance, we are going to be looking this in economic way, it means that an increase in a demand will be causing an increase in supply. And that is why we are going to be doing an analysis of a straight line on a straight line. So it is the same scenario that we are discussing here, whereby a change in one variable is going to be causing a changes on other variables. Let me look on our case here. There are three types of scenarios. There are three types of scenarios. There are three types of scenarios, and this is what the examiner was trying to look on our previous exam. Number one, we normally discuss about best case scenario, right? The best case scenario, it is just a method which is basically used by investors who are most likely optimistic. Let me talk about, it is mostly applicable. It is mostly applicable by the risk takers. Risk takers, you can use that name, or we can discuss about optimistic investors. Optimistic investors. We can be able to discuss about it in that manner. Number two, we are discussing about best case scenario. Best case scenario. And when you look on the best case scenario, we are looking on the people who they normally make decisions. When I look like Mwenda today, you might be saying, can I invest on Safaricom? Apana. Lakini risky already, they are making losses, right? What am I expecting on the next 6 months? You do your analysis and you say, apana, miss Yezi, Nico 50-50, I don't know whether I can be able to invest or not. And these people, it normally represent the risk neutral investors, right? It represents the risk neutral investors. It normally represents the risk neutral investors. Then we normally discuss about number three, where we normally talk about worst case scenario. And the worst case scenario will represent the risk averse investors. The people who they want to do investments on areas whereby they are not going to be losing anything. Because in investments, that is where we say, every time you are making your investments, always know very well that there must be probabilities which are basically assigned to those risks that you are undertaking. So in our scenario here, we are saying that for the worst case scenario, we have already said that it normally represents the risk averse investors, right? Represents the risk averse investors. It normally represents the risk averse investors, and that is what we are discussing today. These people are normally called pessimistic, right? Pessimistic. Every time you want to work, for instance, if there is any investment, if you need any return of investment, every time you have to be undertaking risk. I don't want you or me to be risk averse investors. In this case, I would like to look on areas whereby we are doing the job, like what I know majority of us are not football fans, but we can be able to do what Chelsea is doing. They have already bought around 16 players. These players they have bought, remember very well, not all of them will succeed, right? these people are coming from different leagues and they have already approached a new league. Remember, there are people who will be able to get used to that league. So when they are making their purchase, when they are making these buys, what do they normally consider? They normally look on the players who will be able to fit on the systems in which they are doing. Now, let me come back to the financial management. When I look on the financial management, I have to be analyzing my investments based on how I'm going to be benefiting from them. And in this case, some of the people may decide to, let me just, because I have 100,000, I can subdivide. Tunasemanga, don't put all the, tunasemanga usiweke something on one basket. In that scenario, if you don't want to put all your savings on one basket, some people normally diversify the risk. And that is where we are saying, I can go to the CBK, open a CDs account, right? Deposit 60,000. I will be a risk taker already. Because already I'm investing, because you know very well, bonds ni kama unakopesha serikali pesa. Umepea serikali pesa, si ndio? A best case scenario, these are the neutral investors who will be able to say, mimi nataka niende Mwasibu Sacco, right? I just want to open, right? I just want to open a fixed deposit account. Ama nipe one of the officials who are my friends this money to invest on my behalf. Remember those people, they don't want to take any risk. When we come to the worst case scenarios, we are talking about representing the risk averse investors. They don't want to make any risk. And that is where when we are looking on the measurement of the risk, we normally say, the higher the risk, the higher the return. Mahali popote wewe umeenda na hakuna risk, no return you're expecting at the end of the day. Now, one thing that we want to be looking at the end of the day, when we are making the decisions under the scenario analysis, we are saying that you have to be comparing the percentage change in the NPV from the best case scenarios to the worst case scenarios. And in this case, we have to be looking on what is the effect of the percentage changes, right? So let me tell you one thing here, NB. We have said, we compare the percentage change. We compare the percentage change, right? We compare the percentage change in NPV from the best case scenario, scenario. Normally do that from the best case scenario, with the percentage change, right? With the percentage change in NPV in the worst case scenario. Kwa nini tunaruka? Kuna mtu anaweza niuliza, mwalimu, mbona tunaruka the best case scenario? We just want to do the comparison between the best and the worst, right? Yeah. Because the best already ni kama inatumika as a neutral. Ni kama wakati tulikuwa tunachora number like hivi. Kuna mahali kuna zero. Unaweza enda huku negative ama huku positive. But this becomes it is a neutral. That is what we normally call it the best case scenarios. So when you are going to be making the decisions at the scenario analysis, we have to be looking on the percentage changes in the NPV from the best case scenario with the percentage changes in the NPV in the worst case scenario. Those are the things that we have to be looking on the question, which was tested on the other day. And we are saying very well, if the percentage change from the best to the from the best to the best is higher than the percentage from the best to worst, the project is viable and less risky and vice versa. What am I saying? This is what I'm saying. I'm saying this, if the percentage change from the base case to the best case scenario, I have said if the percentage change from the base to the best is higher, right? To the best is higher than someone to mute is higher than the best, is higher than the percentage change is higher than the percentage change from the best to the worst. From the best to the worst. I want to mute this mic, please. To the worst. The project is viable. The project is viable. Na hii kitu ina tofauti na what we did the other day. The project is viable, stroke less risky. It is upon you to make the decision. It is upon you to make the available decision. Someone to mute his or her mic. I don't know who he is. He or she is. Good.
Yeah.
Mtu ako hapa. Kuna mtu ako hapa.
Baby can say.
So I just want to shift our gears because tukiongea vitu mingi in advanced financial management tunakuwa tunaharibu. Mimi nataka to shift our gears, tufanye maswali. Maswali ndio important. Already najua haka introductory part will be assisting you to do the question of scenario analysis. Wacha tuangalie the question now which we have been asked by some of you. December 2022 question 1B. Najua ile swali umeisoma sana. Lakini there is one person who should be doing the interpretation. Angalie swali ya December 2022. But someone should be doing interpretation for us. Mtu anambie, because you have to be telling the new student, what do you mean by annuity? What is a lump sum in the question? What is the formula to be used? Niliwaambia those are the things that you have to be using under the topic 1. So acha kwanza tuende kwa maswali, right? Let's go shift our gears to the questions. So 2022, sorry. Let's go back there. And I know the new students, I could see Joy sharing this link for question with you. So this is how it works if you have never used it. So maswali zote ziko hapa. Kama na ninahitaji swali ya 2022, mimi nahitaji maswali za 2022. Right? Lazima nikuwe kwanza na net. So in this case, we are looking for December 2022. December 2022. Then I look on my paper, which I'm doing right now, and I'm talking about paper 33, Advanced Financial Management. Question number 1. A new student should be reading for us. Tunataka tuwasikie. Someone to read for us now. I'm not scaring you, but we want to know you. Let me start with who? Jacinta Mwende. Very good. Can you read for us? Jacinta Mwende, unmute, and you read for us.
Hello.
Yes.
The Management College of Publishers Limited has estimated the following initial cash outlays and net cash flows and probabilities for a new printing process in each case scenario. We have year 1 to year 5, the worst case, most probable case, and best case. Then we have probability. Then year 0 is the initial cost of the new printing process. Year 1 to 5 are the operating net cash flows, and year 5 is the estimated salvage value. The firm's cost of capital for a project of average risk is 13% per annum required. Assuming that the above project has an average risk, compute the expected net present value of the project. 2. A sensitivity analysis of the salvage value if its variable changes from the base case value by plus or minus 80%. 3. Assume that all cash flows are positive, perfectly correlated, and that there are only 3 possible cash flows scenarios over time, namely worst case, most probable case, and best case with probabilities of 0.2, 0.6, and 0.2 respectively. Determine the project's standard deviation of the net present value.
Very good. I could see the examiner is giving us a very good challenge there. And I really understand one thing. When I'm being given this question, the first thing that I have to be looking at, because when I look on the requirement number 1, the examiner is asking us to compute the expected net present value of the project. I want Lillian to be able to explain to us, when the examiner is asking us to compute the expected net present value, what are we supposed to be doing? What is the formula to get the expected net present value? Someone? Godfrey? Someone? Godfrey, can you be able to answer our question? Lillian, how do you normally compute the expected net present value? Rose, what is our expected? How do you normally get the expected net present value?
The expected net present value usually do the summation of NPV and multiply by the probabilities.
Very good, very good. So it means the first stage of doing my question here, I have to be computing the NPV of each scenario. We are being given the worst, we are being given the most probable, and then we are being given the best case. Another question, thank you so much. Another question that I will be able to ask. When you look on the cash flows provided by this examiner, from year 1 to year 5, not the 5 with a star, year 1 to year 5, what type of cash flows are these? Someone to answer me. Joy? Year 1 to year 5 are being given cash flows of each scenario, right? Tell me what type of cash flows are we dealing with right now?
Year 1 to year 5, we have annuities.
They are annuities. Can you be able to explain to someone like Jacinta Mwende, who have never been attending any AFM class, why are you saying they are annuities and not lump sum? And what is an annuity?
The figures are the same, they are regular. If they were irregular, let's say like 30, 40, that could be lump sum.
Thank you so much. So for the new students, you have to understand that when the cash flows are similar, we normally call them in financial management, these cash flows are normally called regular cash flows. It means if, for example, I have done an investment of 100,000 in a certain kasako, unajua nilisikia hapo before economy kuwe ngumu, lazima to invest mahali. We used to have that knowledge, right? Let's invest on any circles. Hizi najua hakuna pesa hata investment, tunakula yote inaisha. So in this scenario, look on from year 1 to year 5, nilienda nikaeka 100,000 on a certain circle without adding anything on the capital amount. It's just 100,000. So it means every time I'm going to be paid dividends, right? Ile pesa na withdraw. So to send the dividends in that organization, I'm receiving 10,000 in every year. When they declare, wanapea done 10,000. So it means, right? It means that for the period until my maturity period, I'm just going to be getting 10,000 each year. That is what we discuss about annuity. But Jacinta, when you find, right, Ama Evelyn, when you find that in year 1, the cash flows are 20,000. Year 2, the cash flows are 50,000. Year 3, the cash flows are 30,000. That is what we discuss about irregular cash flows, right? And we normally use the formula of lump sum, right? In the determination of the present values. In the determination of the present values. So in this case, because already I just want us to understand these concepts once and for all, it means examiner here is asking us to compute the NPV of each case scenario, right? Let us go to our board. You can be able to open the question on your part, on your side. Let me do on my side here.
Question.
Yes, yes.
Question before.
Yes, yes.
I wanted to ask from the other screen the question part.
Okay, let me
Since
share it.
the requirement is assuming the project has an average risk.
Yes.
Doesn't it mean that now you don't have to do all cases, but now the most probable case?
Now, in this case, it's just like an examiner is telling you, let us our probability be equal 0.3%, 0.3, sorry. That it means it is an average risk. The risk applies to all the case scenarios. Common risk of 0.5 applies to all the case scenarios. Are you understanding?
Yeah.
That is what the examiner is asking you. Let it be an average. It covers all the 3 case scenarios. What would be the NPV? What would be the NPV? That is what they are asking. So when you go, right? When you go, na kuna kitu sijauliza mwanafunzi mwenye nilianza kufunza kama immaculate. Hii 5 imewekwa star ndio nini? Hii 5 imewekwa star ndio nini?
Terminal cash flows.
Thank you so much. That is the terminal cash flows. Examiner hapa amekukalkuletia kila kitu, right? Kazi yako tu ni ushindwe kupata NPV. Examiner amekupea everything. Amekupea cash flows, right? Amekupea initial outlay, which is amekuambia from year 0, 100,000 will be my initial outlay. Amekupea cash flows generated in year 1 to year 5. That is the during the overall project duration. Then amekuambia year 5, the terminal cash flows, you are going to be receiving your annual net cash flows together with the terminal cash flows. Akakupea vizuri, right? Nishaelewa swali kama namna hiyo. This is how I'm supposed to be calculating my NPV. This is what I'm supposed to be calculating my NPV now. I know now there is no much questions. So now, examiner was asking me to get the expected net present value. We say, take the summation of NPV, then you multiply by the probability. Ukiwatch already the video yetu ya kwanza, you will be able to know what happens in the absence of the probabilities, right? And then, because already we are going to be discussing about the sample sizes, you will be able to see how the video is going to be directing you if the probabilities are not available. What am I going to be using? That is the case. That is now is an assignment for you, for the new students. They just go and watch all the videos. You'll be able to understand the concept very well. Now, in this case, I will be able to start with the worst case. Worst case. Na nimeambiwa hapa ni calculate NPV. Tulisema nikiangalia zile cash flows provided by the examiner here. The cash flows provided by the examiner. Nimeona in the worst case amenipea 20,000. Right? 20,000. And because we want to determine the present values, na hii ni annuity, we normally multiply by the present value interest factor annuity. The cost of capital, we are being given 13%. And the duration for the project, we are being given 5 years. Right? Plus what? The terminal cash flows. The terminal cash flows is just received once, year 5. That is lump sum. So hapa nita multiply na 5,000 times the present value interest factor. Na hii haina ka A because haina annuity. It is normally received once at the end of the project. 13%, 5 years. Then we subtract our initial outlay. Examiner ameniambia mwalimu initial outlay yako ni 100,000. So itakuwa pesa ngapi? So nitakuja hapa nijiambie vizuri, right? This one I'm dealing with annuity. Nikienda kwa ile paper mwalimu amenipea, not mwalimu but the examiner. Hebu aje tuangalie from the examiner point of view. Nikiangalia hapa examiner nakupeanga 2 tables. Na sijui kama kwa hii paper iko nayo. You can see it is not there. So no problem with that. I will be able to show you on another questions. But we normally have 2 tables provided by the examiner. They can't miss in an exam, right? They can't miss there. So in this case, when I come across this kind of a question, I just want to teach myself how to apply formulas. Mimi sitakangi kuangalia hizo papers because they waste a lot of time. Mimi na try nitumie formula. So in this case, I will say the formula for the present value interest factor annuity, you normally take 1 minus 1 plus r raised to a negative n divided by r. The formula to get this one, you normally just take 1 plus r raised to a negative n. Raised to a negative n, right? Na hizi formula utazipata. Formula, by the way, table ya kwanza inakuanga ya lump sum. This is lump sum for the new students. Hiyo ni lump sum. Inamaanisha lump sum, you receive the cash flow once. Kama ni 5,000 once. It means the next period I'm going to be receiving differently. Then this is what we are calling it annuity. That is what we are calling annuity. So how am I going to be getting this discount factor here for me? So when I'm applying the formula, it will be 1 minus 1 plus 0.13, which is your rate. You raise to a negative 5, divide by 0.13. Plus, right, 5,000 here. You multiply by, right, we are talking about 1 plus 0.13. You raise to a negative 5. You subtract 100,000. So it means here I'm multiplying with 200,000. The 200,000, 20,000. 20,000 there. So in this case, put this data on your calculator. So tunaanzia wapi? So I have mine here. I have my calculator. It will be 1.13. This plus this one is 1.13. You raise for negative 5. 1 minus answer, right? Then we divide by 0.13. I'm getting 3.5172. This one we multiply by 20,000. Plus 5,000, we multiply by 1.13, you raise for negative 5. I'm getting 0.5428 minus 100,000. So sinini rahisi. You can put it on your calculator. I just say 20,000 times 3.5172, right? 3 point that one, right? 3.5172 plus 5,000, I know we are together to that point, times 0.5428, right? Minus 100,000. 100,000. Mimi napata negative here, Kenya shillings. Negative 26,942. Immaculate unapaswa kuniambia wakati NPV ni negative. How am I supposed to be making the decision? When the NPV is negative?
You reject the project.
You reject the project. When the NPV is negative, you reject the project. Thank you. So let us go to the most case. And we look on the cash flow. Nothing now is going to be changing, by the way. Because the number of years and the discount and the cost of capital is the same. So in this case, just look on the cash flow. The cash flow for the most case is 30,000. You multiply by the discount factor, 3.5172 plus, right? When you look on the terminal cash flow for the most case, I could see we are being given 20,000. Is it 20,000? Let me go back to my question. Most probable. It should be the most probable case. Most probable case. So 30,000, we are being given all that. The discount factor, sorry, the terminal cash flow should be this one. The discount factor remains 0.5428 minus 100,000. How much is our NPV under the most probable case? So I just say 30,000 times 3.5172 plus 20,000 times 0.5428 minus 100,000. 100,000. Getting 16,372. 16,372. Then let us go to the last one. Let us go to the last one to get the last marks. We have been talked about the best case. The best case scenario. When I look on the annual net cash flows, we are being given 40,000. We multiply by 3.5172 plus the terminal cash flow for the best case, it will be 30,000. We multiply by 0.5428 minus 100,000. And also how much am I getting there? So it will be 40,000 times 3.5172 plus 30,000 times 0.5428 minus 100,000. And I'm getting 56,972. 56,972. But remember, your examiner needs the expected NPV. So nakuja hapa nasema to get the expected NPV, we have to be multiplying our NPVs, which we have already gotten here, with the probabilities. Now, in this case, the first one will be negative 26,942. You multiply by the probability given, 0.20, plus the next one will be 16,372 times 0.60 plus the last one will be 56,972 times the probability given there will be 0. I think it is it 0.2? Let me check. Yes, it should be 0.2. So what is the expected NPV? Right. The expected NPV, it will be negative 26,942 times 0.20 plus 16,372 times 0.60 plus 56,972 times 0.20, getting 15,829.2. 15,000 something like that. 829. Are we in agreement up to that point? Evaline, do you have any question? Any questions so far? Unafungua unasema kitu. Now, the requirement part 2, we have been told a sensitivity analysis of the salvage value. If this variable changes from the base case value by plus or minus 80%. 80%. So huyu examiner anatujaribu sana, right? Remember already we said when you're looking on making the decisions or using the scenario analysis, we were able to say you have to be looking on the percentage changes. And you remember there is a question for sensitivity analysis which we were able to do. Remember the sensitivity and the scenario, they rhyme, right? Remember we said just a change in one variable will be causing a changes on the other variables. So that is the only change that we have between the sensitivity and the scenario analysis. But because already this question mostly looks like a scenario question, so let me tell you about one thing. Examiner is asking us to compare between the best and the worst case scenarios, right? While we are doing the sensitivity analysis. Let us look at it. Let us look at it here. Wacha tuangalie hapa. Examiner atuliza, let us first calculate the salvage values. Part 2. We are looking on the worst case. Worst case here. So in this case, the worst case, it means you take your cash flows, which is 100%. You subtract 80%. Because umeambiwa the difference of 80%, which translates to 20%. Because we have been told about the positive and minus. So si tushaanza na minus. Tukapata 20%. So the first thing that you're supposed to be getting is called salvage value. So how am I going to be getting the salvage value? We are going to be arguing about our cash flows. We are going to be arguing about the terminal cash flows of the base case. And those cash flows, the terminal cash flows for the base case will be 20,000. So it will be 20%. You multiply by 20,000. And you are getting Kenya shillings 4,000. So when you are calculating your NPV in this scenario, right? For the worst case now, you are calculating the NPV. You are going to be taking the cash flows, right? There is our cash flows for the annual net cash flows for the worst case, which you are being given as 20,000. You multiply by the discount factor, which is 3.5172 plus the salvage value of ours now changes. Remember that the other time we were doing with 5,000. Right now we are doing with 4. right? Because we have already considered the salvage values due to the variable changes from the base case. So in this case, it is 4,000. Then we multiply by the discount factor, which remains at 0.45428. Nani ajui 4,000 imetoka wapi? Someone? Someone who doesn't know where the 4,000 has come from? Lillian, is it okay? Hello?
Me, I don't know.
Very good. Huyo amejisemea. Mwingine?
Hata mimi niko confused.
Mimi nimekuambia vizuri. Tukiangalia because already nakumbuka hata nikichora hapa kakiri panakaa namba 19. Tuko na base case. The base case tumepewa kitu inaitwa, right, terminal cash flow. So the terminal cash flow provided there tumepewa 20,000. Ndio pate hii salvage value tunatumia hii 20,000. Tukiangalia the changes in the variables between positive and minus. So mimi nimechukua variable yangu yenye ilikuwa 100%. 20,000 ilikuwa 100%, right? But tunaambiwa tuangalie the changes between the 100 by 80 because the changes is minus and plus 80%. So nikakuja nikachukua 100% minus 80 where we are getting the worst case scenario to be 20%. So nikakuja nikasema to get my salvage value, take 20% times the terminal cash flow ya best case which is 20,000. Umeiona? Umeiona hii 20,000? Sasa nikiongea peke, tumeiona the 20,000.
Yes, yes.
Unaona kwa most probable case. Si tuko na 20,000 pale chini kabisa? Si ndio?
Yes.
Very good. Hiyo ndio inakusaidia kutafuta the salvage value. Si sawa? Ni kama venye tukiwa pale high school ulikuwa unasema we kama Godfrey amekuja namba 10, mimi naweza kuwa number 1. That is how we measure ourselves. So mbona umesema umekuwa number 1? Wewe unajiona mwerevu kumuliko, si ndio? So you have already added yourself. So tunatumia positive or negative. So the negative aspect, we are getting the difference of 20%. Tukienda ile ingine ya positive, it will be 100 because we are being told the worst and best. The worst and best. So it will be 100% plus 80 we are going to be getting for the best case scenario. And then we calculate the salvage value for the best case scenario by taking 180% times the 20,000 for the salvage value because we just want to get the salvage value, nothing else. Then you get your NPV under that scenario. Then we look on the percentage changes for that scenario. Tutaangalia hizo vitu baadaye. So ukiangalia the NPV in this case hapa utapata ngapi? The NPV in that case utapata ngapi? I think we are going to be getting negative. We are going to be getting negative there. Negative 27. Negative 27,485. So ukienda bado ufanye best case. Angalia hapa vizuri. Best case utachukua bado ile 100 because umeambiwa negative, positive, negative ushafanya. So for the best case it will be 100% plus 80%. That is the best case. So it will be equivalent to 180%. Calculate the salvage value for the best case. Salvage value. And it will be 180%. You multiply by the terminal cash flow for the most probable case, 20,000. Right? How much is this? Zero, is it zero? No. 1.8 times 20,000. We are getting around 36,000. So wewe endo tafute the NPV now.
Excuse me, sir.
NPV. Tafuta NPV now for the best case. Hakuna kitu mingi hapa. So unakuja hapo unasema to get the NPV for the best case, look on the cash flow. The cash flow will not change. Cash flow yake tumepewa, right? The cash flow yake ni ngapi for the most, it should be the most for the best case, the cash flows I can see is 40,000, right?
Excuse me, sir.
Yes, yes.
From the equation,
Mm-hmm.
a sensitivity analysis of the salvage value, if this variable changes from the base case, and under your working, I'm only seeing you are using the cash flow of the worst case. Why are you not considering the best case?
Good, because I told you in our notes that if we are going to be looking on a sensitivity analysis or the scenario analysis, we have to be looking on the percentage changes from the best case. Best case ndio unatumia kufanya the analysis between the worst and the best. Remember the cash flow zenye tunatumia hapa, tunatumia the terminal cash flow ya best case. So the best case is the one that is assisting us to calculate the salvage value. It is just like acting as it is our NPV, by the way. For example, like a mean. Wakati ulikuwa unafanya your decisions ukitumia normal, right? Ulikuanga na NPV. So when you look at it, it means the most probable case, ama tuseme best case is our mean. So nataka kujua hii huku na nijue the other side to make a decision. That is what we are saying. But we normally base our argument using the best case. Pamoja mpaka hapo? The best case is the one that is assisting us to make the decision. So hakuna venye nitakuja ni calculate again. Because sasa nitacalculate nikitumia nini? Is either if I subtract, I get the worst. If I add, I get the best. Pamoja mpaka hapo?
Yes.
Yes. So that is why we said if we look on the making the decisions here, we are going to be looking on the percentage change from the best to the best. Is the higher than from the best to the worst, and the project will be viable and so on and so forth. So when I look on for the best case scenario now, for the best case scenario, we are going to be checking on the NPV, and when you look on the cash flows for the best case, it is 40,000 times 3.5172, right? Plus 36,000 times 0.5428. Then you subtract 100,000. 100,000 there. 100,000. Are we together up to that point?
Yes.
Good.
Yes.
So hii itakuwa ngapi? Kenya shillings. Kenya shillings. So it will be 40,000 times 3.5172 plus 36,000, right? That's 6,000 times 0.5428 minus 100,000. We are getting 60,229. 60,000, something like that. 60,000, 60,229. 629. So how am I going to be doing my percentage changes? Am I going to be doing my percentage changes? So to calculate your percentage changes, we are going to be looking at, when you're going to be doing your percentage changes, what are we going to be doing? What are we going to be doing? Let me look on something here. 1 minute. I compare some notes here. It will be good. Okay, so it will be, let me look on something, then I will proceed. Thank you. Now, when you look on the percentage changes, when you look on the percentage changes, it will be for the worst case. For the worst case, unakujanga hapo unaangalia already what was the NPV, right? What was the NPV which we calculated for the most probable case? Now utapata the NPV that we got was 16,372. Because it's our base, right? So the NPV of the most probable case yenye mlikuwa mnaniuliza was 16,372. Ndio itatusaidia kucalculate the percentage changes, right? Minus the NPV that we have already done here for the after the minus and positives is minus 27,485. Divide by our base, which is 16,372. Then you multiply by 100%. NPV ndio tulipata pale juu for the first requirement. So 16,372 was for the most probable because the examiner anakuambia uitumie. So that is why we are saying a sensitivity analysis of the salvage value or the variable changes when we are using the base case. That is when nimetumia NPV yake. So it will be 16,372 minus 27,485, right? Divide by 16,372. You are getting around 268%. 268%. Then we look on the base case. The base case will be, right? Ni kama tunachukua the highest will be 229 minus the NPV of the base case, 16,372, right? You divide by 16,372, then you multiply by 100%. You multiply by 100%. So it will be equivalent to the same, 6229, right? Minus 16,372, you divide by 16,372, then you are going to be getting 268%, right? Remember, this is on the side of increase, and this will be on the side of decrease. Lillian, is it okay? Lillian? Immaculate, is it okay?
Yes, it's okay.
Good. Godfrey?
It's fine.
Immaculate, okay, no, who else? Namuli. Good evening.
Good evening.
Is it okay?
No, I'm just wondering why you are saying decrease.
Why am I?
Increase. Saying decrease and increase.
Okay. Mimi naona kuna mahali ya muelewi hapa. Mimi nilichora kanamba la hivi. Nikakwambia una making decisions zako kutumia NPV under the advanced level. Na NPV yenye tunatumia ni ya base case. So tunaambiwa, let's look on whether it will be, what will be the worst case scenarios? What will be the NPV of the worst case scenario? Na the NPV of the worst case scenario ndio ulipata -27. Na hapo kakuja unaambiwa, angalia the NPV of the positive side, which is the best case scenario. Ukakuja hapo ukafanya the percentage changes. Ukapata the NPV to be 6229. That is on the best case. Right? So mimi nakuja hapa nasema, wacha niangalie kama kuna percentage changes. Na napata hizi percentage changes haiko. Kwa nini haiko? Because we are using the same base case NPV. That is why unaona ziko the same. Hii ni a decrease on the side of decrease, on the negative side, because hapa nikianza kuandika number line itakuwa 0, -1 or that to -27,000. That is on a decrease side. Then on the other side will be on the increase, because already the percentage changes keep increasing. Ukiangalia the NPV yenye tukicalculate pale juu na the one that we have gotten here when we are using the sensitivity analysis, umepata hii NPV is more than what we got from the normal NPVs that we did. So when you do the percentage changes, then the NPV, it tells us that there is an increase in the NPV from the previous one that you got. Tumeelewana hapo?
Yes.
Good. So that is how we are looking here. When I'm making my decision, Tasema, there is a decrease by 268% when there is a percentage changes. Then there will be an increase by 268% when I consider the percentage changes and the changes in the variables. Just like that. Just like that. This is what we did, by the way, in the other class. And it was the same, but in another approach. That is why I told you, I'll be able to teach you the two approaches. Yenye inakufit, it is the one that you're going to be using, but both are okay. Both are okay. Kuna mtu amenisaidia hapa na anasema no, kindly repeat the best case percentage changes. Jacinda, talk to me now and tell me if everything is okay.
Yeah, nimeelewa sasa.
Oh, thank you so much. Now, that is why niliwaambia lazima tusome pamoja. Hii kitu ukikaa hivi siku mbili hata utaijua mwalimu alikuwa anamaanisha nini hapa na pale. So that is why I normally say read after. Nikimaliza hivi wewe unasoma. Wewe ukimaliza hivi kesho. Now if I give assignment today, tomorrow just do it. Just do it. Hautaipatana na mashida. Now let us shift our gears, then we do the last requirements. Let's do the last requirement and then we shift our gears. The last requirement here. The last requirement inatuuliza nini, Jacinta? Requirement number 3.
Assume that all cash flows are positive, perfectly correlated, and that there are only 3 possible cash flow scenarios over time, namely worst case, most probable case, and best case, with probabilities of 0.2, 0.6, and 0.2 respectively. Determine the project's standard deviation of the net present value.
So mimi hapa nakuja naambia examiner wangu, to get the standard deviation, we normally take the root of. Mimi nakumbuka wale watu wametoka kufanya statistics walikuwa wanachukua x minus x bar. Ukikuja advanced level, we say take the summation of NPV minus expected NPV. Expected NPV squared, then you multiply by the probabilities. Sini sawa? Na bado tukienda kwa portfolio theory, these are the jobs tutashinda huko tukifanya. Now in this case, remember there are NPVs zenye tulipata hapa, zilikuwa hapa 3. Then tulipata 3. So the NPV na tukapata the expected NPV. So in this case, you just copy, we start with the worst cases. So for the worst will be, I remember the first NPV zenye tulipata for the first requirement, ilikuwa negative 26,942. 942 minus the expected NPV ilikuwa 15,829. 829, right? This will be squared. Then you multiply by the probability of 0.20, right? Then you go to the next one. We talk about base case. We talk about the base case. The base case ilikuwa the previously tulikuwa tumepata 16,372 minus, right? 15,589, 15,829, sorry, squared. Then you multiply by 0.60. Then the last one will be best, right? The NPV ilikuwa ngapi? The NPV ilikuwa ngapi? The NPV ilikuwa 56,972 minus 15,829 squared. Then you multiply by 0.20, right? So in this case, nasema, let me start with the first one, minus 26,942, right? Minus 15,829 squared. Then I multiply by 0.20, getting 365,871, right? 688.2. The second one will be 16,372 minus 15,829, right, squared. Then I multiply by 0.6, getting 176,000, 176,909.4. Then the last one will be 56, 972 minus 15, 829 squared. Then you multiply by 0.20. Confirm the figures. Godfrey,
Yes, yes.
are the figures okay?
Yes, they are.
Good. Get your totals there. So plus 176, 909.4 plus 365, 871, 688.2. Mimi naona nikipata something equivalent to 704, right? 597, 887.4. So mimi naenda pale because nataka standard deviation, nachukua the roots. Nikuja hapa nachukua the root of it. So the root itakuwa namna gani? It will be looking like this. The roots, it will be, right? 704, 597, 887.4. Nitapata ngapi standard deviation? So standard deviation should be 26,544. 444. Lilian, tuko pamoja mpaka hapo? Lilian ama alienda kabisa, alitoroka. Rose, is it okay?
Yes, it's okay.
Very good, very good, very good, very good. I just want us to do another question for the scenario cases. And then after we do that, then I will be able to shift you to other areas, which we have to be concluding. Yeah, we have to be concluding. Then tomorrow, tutamalizia another concepts. Then tumalizana na hii topic kabisa. Now, I just want us to look on another question which was tested on 2019. There is a question for 2019 November. And I remember we have already done this question. We have done this question again. So it's just a repetition of what we have done. I have to repeat it for my new students. So this is how the question was. So here itatusumbua sana for understanding. Is it November? November 2019, yes. Good. Because I can see the requirement part 2, we are big given there. But someone to read for us from requirement 1, we do all of it. For B and C.
I'll read.
Yes, yes.
Sunny Technologies Limited is considering investing 50 million in a new machine to manufacture computer microchips, which are with an expected useful life of 5 years and no salvage value. It is expected that 20 million units of microchips will be sold each year at 3 shillings per unit. Variable production costs are expected to be 1.65 shillings per unit, while incremental fixed costs will be 10 million per annum. The cost of capital is 12% required. Evaluate the sensitivity of the project's net present value to the following changes. 1, sales volume. 2, sales price. 3, variable costs. Then further analysis of the company in B above suggests that sales volume could depend on expected economic state as follows. Economic state.
Continue.
The poor probability: poor 0.3, normal 0.60, good 0.10. Annual sales volume units: poor 17,500,000, normal 20 million, good 22,500,000. Required: the expected net present value of the project using scenario analysis.
Very good, very good. So let us start from the just repetition of what we have done. Remember already we have a format in our first video. When you look on our first video, you'll be able to realize that there is a format on how you're supposed to be calculating the NPV. And when I look on our NPV in this scenario here, there is no incidental cost because already we have been told the cost of that machine will be 50 million. So in this case, because already the examiner is asking you to evaluate the sensitivity of the project and under the following. So in this case, we remember we had already discussed about the sensitivity analysis, and I gave you some formula for that. I said you just need to be taking the NPV of the project, you divide by the present value of the decision variables, you multiply by 100%. Let us look on our solution here. Let's have our solution straight away. So in this case, you just come and you tell the examiner, we have to be calculating the sensitivity ratio. Sensitivity ratios. And to calculate the sensitivity ratios, we said, take the NPV of the project. You take the NPV of the project, you divide by the present value of the decision variable, then you multiply by 100%. So in this case, I just want to start by looking on the NPV of the project. In this case, the NPV, we said it normally follows 3 stages. Number one, we said, let us start by looking on the initial outlay. And in this case, we don't have much. The initial outlay, we are being given as 50,000. Let us limit our 1,000 into shillings. Into thousands, sorry. Our shillings to thousands. So our initial outlay is 50,000, right? Number two, we say, calculate your annual
net cash flow.
Cash flows, right? And in this case, when I look on the annual net cash flows, this examiner is telling us that, let me go back to my question. The examiner is telling us that that it is expected that 20 million of the units of microchips will be sold each year. It means our question is annuity for the whole of 5 years. So it will be 1 to 5 years, right? And then we limit it to thousands. So we said, right, we are going to be starting with a contribution. Am I going to be getting the contribution per unit? Tumeambiwa hii microchip moja inauzwa 3 bob, then we minus 1.65. I can see that is the variable cost, right? Then we are selling how much? 20,000 microchips. So what will be our contribution? And you'll be able to find our contribution will be, just take 3 minus 1.65. Then I multiply by 20,000, getting 27,000. Then we less our fixed costs. And we say our fixed costs should be equal to 10 million. Now in our case is 10,000. What are we getting here? Only before depreciation and taxes, it will be 17,000. Only before depreciation and taxes will be 17,000. The biggest question will be, am I going to proceed in the calculation of the, because already you can see we have not deducted our taxation, we have not added back the depreciation tax sheet. I will be able to tell you this. If the taxation, if the corporation tax rate is not provided, and also if the taxation, if the taxation rate is not given, the corporation tax rate is not provided, then there is no any computation of taxes. Huwezi jitolea kwa kichwa. Kama examiner hajapeana kwa swali, also don't do it. So it means that the annual net cash flows of ours, it will be 17 annual net cash flows. Usiende ati useme mimi najuanga the tax rate is 30%. Kama yuko kwa swali wewe usifanye anything else, right? Because kama tax rate yuko, then it means also you cannot be able to do the depreciation tax sheet. Swali inaishia hapo. That is the annual net cash flows. Nikiangalia swali haina terminal cash flow, which is always the third step. Swali unamalizia hapo. That is how it was. Now, when the examiner is asking us to calculate the sensitivity of the project net present value of the following changes, we start with number 1, sales volume. Naambiwa sales volume. So we have said, take the NPV of the project, which is 17,000. right? The NPV of the project, I have not done it, sorry. The NPV of the project, sorry for that. Let us first calculate the NPV. So we say, to get our NPV, let's take our 17,000. This is annuity. We multiply by the present value interest factor annuity. What is the rate? We are being given the rate is 12%, right? We say 12%, 5 years. Minus we minus our initial outlay, which is 50,000. So how much is this? So in this case, let me use the formula which I said here. We said you take 1 minus 1 plus r, raised power negative n, you divide by r. So it will be 1.12, you raise power negative 5, 1 minus answer, then we divide by 0.12. And I'm going to be getting here 3.6048. 3.6048. So 3.6048, I multiply it by 17,000. Then I subtract 50,000. I'm getting 11,282. 11,282. So when I start by computing this, the sensitivity analysis we have said, start with sales volume. Take the NPV of the project. We say the NPV of the project now becomes 11,282. We divide by, right, 11,282. We divide by the volume that we are selling is 20,000. And remember, you have to be discounting it to get the present value. How am I going to be doing it? I'm going to be dividing by 20,000, which are units. Multiply by, right? You multiply by, how much am I multiplying it with? Sorry, I'm going to be multiplying by the present value interest factor annuity, 3.6048. Then you multiply by 100%. So how much it is? So in this case, I'm going to be taking, right, we divide by, let me open my brackets, 20,000 times 3.6048. I'm going to be getting 15.65%, right? Let us go to number 2. Number 2, we have been told the sales price. What is our total sales? So in this case, take the NPV of the project, 11,282, divide by the sales. Sales zetu total ni ngapi? 20,000 times 3. You get 20,000 times 20,000 times 3. Then you discount to get the present value. You discount to get the present value. 3.6048 times 100%. So how much it is? So just say 60,000 times 3.6048, right? So 11,282 divided by my answer, I'm getting 5.22%. Then number 3, right? Our number 3, we are discussing about the third problem, which we are discussing about the variable costs. The variable costs. So to get over the variable cost is very simple. Take 11,282. Divide by, the variable cost per unit is 1.65. Times 20,000. Times the present value, 3.6048. Times 100%. So in this case, how much it is? 1.65 times 20,000 times 3.6048. Right? So 11,282 divided by my answer, we are getting 9.48. 9.48%. 9.48%. That is how you normally calculate those changes under the sensitivity analysis. But now part 2, the examiner anatuliza swali pale. Part C, sorry. We are being told further analysis of the company in B above suggests that the sales volume could depend on expected economic states as follows. Tumepewa probabilities na annual sales volume they are provided. So how am I going to be doing this question of mine? It will be easy. So in this case, remember we are discussing about only 2 things. The normal become our base. Our normal is our base. So swali yangu nafanya namna gani? Swali yangu nafanya very simple with this man. Normal is my base, right? So we are discussing only poor and goods. Get the NPV for both. Unaweza kuja tu hapo unifanyie hivi. Kuja hapo niambie aje. Now, let us look on the changes because already we are discussing about part C. So examiner ametuambia, let us look on the scenario analysis and we are going to be looking on the poor side of view. So in this case, let us calculate the annual net cash flows for poor. It will be looking like this. Let me talk about poor now. Poor. And because I want to get the annual net cash flows, annual net cash flows. Examiner ndio ananiuliza kitu kama hiyo. So in this case, tumepewa new sales volume for the poor, which will be 17.5. Let me talk about 1 to 5 years. Right? So we start by looking on the contribution rate. So contribution yake ni 3 minus 1.65. You multiply by 17,500. So how much it is? 3 minus 1.65 times 17,500. I'm getting 23,625. That is my total contribution. Then we subtract our what? We subtract our fixed cost. We less our fixed cost. So our fixed cost will be, the fixed cost still remains at 10,000, right? The fixed cost remain at 10,000. So what is my annual net cash flows? Because najua hakuna kitu ingine na factor there. In this case will be 13,625. 13,625, right? Then the other one will be 13,625. The other one will be for the goods. You do the same. So let me just do it straight away. 3 minus 1.65. It will be 1.35. You multiply by the sales volume is 22,500 minus 10,000. How much it is? Times 22,500 minus 10,000. This one will be 20,375. 20,375, right? Remember now, we are already having our NPV under the normal part. Remember the NPV remains. Yenye tumepata pale juu, which you got 11. It was 11 to, is it 11,000? Let me confirm. It was 11,282. 282. That is the NPV of the normal. So there is no any problem with that. Remember the expected, we have been told to come up with the expected NPV, right, of the project using the scenario analysis. Nothing more. So in this case, nishapata hii na nimepata hii na najua the normal ile nilipata half there, 11,282. So what am I going to be doing right now, right? What am I going to be doing now? This is the NPV and normal, sorry. That is the NPV and normal. Let us look on the NPV ya poor. For poor, it will be, nimechukua the annual net cash flow 13,625, right? The discount factors will not be changing. I just copy 3.6048. Najua unajua mahali imetoka. Minus our initial outlay, we were discussing about 50,000. Our initial outlay, which was 50,000. Now, when you look for the good now, it will be 23,75 times 3.6048 minus 50,000. So how much would be? So 13,625 times 3.6048 minus 50,000, right? Getting negative 884.6. 884.6. Then the other one will be 2375 times 3.6048 minus 50,000. Getting 23,447.8. Calculate the expected NPV as the requirement of the examiner. So let me start with this one. Negative 884.6. We multiply by The probability provided is 0.3 plus the NPV ya normal ni ile tu tulipata huko juu 11,282 times the probability provided is 0.6 plus the last one will be 23,447.8 times the probability provided, which is 0.1. What is your expected NPV? So it will be negative 884.6 times 0.3 plus 11,282 times 0.6 plus 23,447.8 times 0.1. We are getting 8848.36. 8848.6, sorry. 8848.6. That is how you are able to get your 6 marks. You are not your 6, but you are 5 marks. You are 5 marks. Any question? That is how you do these questions of scenario. Ukiambiwa percentage changes, ishakuonyesha how you're supposed to be doing it. I have shown you how to work on it. Any question? Any question? Hata mimi leo sipeani assignments, but I will be tomorrow we are going to be doing certainty. Let me write it here. Certainty equivalent coefficient. Equivalent. Ilikuwa imetestiwa tu juzi. Equivalent coefficient. So certainty coefficient, certainty equivalent coefficients. We are going to be enjoying CEC. It is normally called CEC, by the way. Na hii topic yetu ya kwanza itaisha kesho kabisa. CEC. So we are going to be looking on it broadly, and also we look on that illustration which they tested the other day. Then from there, I'm very aware that we will be able to do something like capital rationing, which we did some time back under section 3. Later on, we are going to be looking on evaluating projects with an equal life. We do a question which they tested in 2017. From there, we are done. And then we should be able to focus now on portfolio theory and analysis next week. Any question? Any question? Is Eric in today? Can I see Eric? Eric is absent today. So let me wish you good night and hope to see all of you tomorrow.
Good night.
Good. Thank you.